Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter. 7 years and running, serving savers and investors across North Central Florida for more than 30 years. The team from GulfCoast Financial Services, founder and CEO John Kuykendall, here providing the perspective, the guidance, the information, helping to clarify the financial world and giving us the instructions on what we need to be doing with our money, what we need to be paying attention to and thinking about with our investments, with our planning. John, always appreciate the time and the guidance, more appreciated now than ever. We've got some headwinds and some speed bumps here in the economy to start 2022.
Well, I got to tell you, 2022, I knew was going to be rough, but I didn't realize how rocky it was going. We had no idea that the Russians would invade Ukraine, and we had no idea that oil prices would go crazy. And taxes, are continuing on the forefront, but right now we're more concerned about inflation than anything else, which has been driving the market crazy. You look at it in the morning, it's up. You look at it at noon, it's down. Middle of the afternoon, it's up. At the end of the day, it's down. It's just a crazy time right now, Peter. And very nervous, nerve-wracking.
And then the Fed's weapon to try to quell and combat inflation is rising interest rates, which for savers on the surface would sound like a good thing, but for investors and for the market and for anyone trying to borrow or finance for any reason, maybe not so good. So where do you see all of this kind of coming to a head and coming together? What do we need to be doing with all of this information and all of these different pieces that are impacting our dollars?
Well, unfortunately, there's a lot of information out there. A lot of it's bad. A lot of it is self-serving. I don't see the stock market crashing. I don't see us, losing all of our money. I don't see the banks coming out with cyber securities and taking away the dollar. I mean, there's a lot of information, misinformation that's being fed into investors, into clients' minds. And first thing we need to do is not panic. Hopefully we have a plan in place that will help us get through this. We don't want to panic so much that we get out of the market totally because the market's going up and down, and we end up not getting the upside when it does begin to go back up. So I think what we need to do is take a look at our risk, analyze our risk and our stage in life. If we're older, we have to have less risk than if we're younger. But the main thing is look at your portfolios. We've had a lot of run up over the last 12, 13, 14 years now. We haven't really seen a market quite as volatile as this one recently. And a lot of investors aren't used to this. So we've had a lot of new investors come into the market during this period of time where all they've seen are the great ups. So now we got to get ready for the downs, which we can do if we're properly diversified and if we know what our risk number is.
So maybe, John, taking all of that into account, not so much trying to time the market or react to any of these factors, but having a plan that is appropriate for our time and our time horizon for when we actually plan to need or use our money and investments.
Well, we always say here at GulfCoast that we start with the income plan, and that's at any age. At any age, we should be able to tell me, okay, this is how much money I want during retirement. In today's dollars, we can show it in tomorrow's dollars. And so we'll try to bridge the gap between where we are and what we need and come up with a plan to save for that goal. So whether you're 30 years old or whether you're 80 years old, you should have an income plan in place that reflects where you are in life and what your spending is and what your goals are. I mean, we need to make sure that if we're young, that we're taking enough risk that we're going to be able to grow so that we're going to have that amount of assets when we get ready to retire that we need. And if we're in retirement, we need to make sure that we're not drawing out of our accounts in a down market and we're spending more than we should. So that income plan, Peter, it is the key to everything, I think. And it's where we start, and then we work away from that based upon where we are in life.
John, we have been told in order to make financial progress that we've got to just deal with all of those factors that you've talked about. We've got to take risk and be comfortable with the possibility of Russia and spiking oil prices or inflation or interest rates or supply chain issues. That's just par for the course and part of the investment experience. And in order to make the progress that we need, that we've got to expose our dollars to risk. Is that a fact? Is that true? Is that something that in order to make progress, we are just going to have to be comfortable with the fact that at any moment the market could change and turn direction and shift the other way?
Well, here at GulfCoast, we're more tactical. We like to take a look at the market, figure out where it's going, and then we'll make moves based upon where the market is. Right now, energy and utilities is a great place to be because, the energy mutual funds are up 50% for the year at this point in time. So we'll shift our portfolios based upon what segment of the market is yielding well, still keeping in play value and our other investments, but leaning more towards a segment of the market that's growing. We have to have some kind of risk no matter what our age is, but we don't want to have so much risk that it jeopardizes our retirement. If I'm in retirement and I'm living off of my money, I can't afford to just put my statements in the drawer and not worry about how my account's doing. Because if I'm drawing money down, the subject running out of money.
And you mentioned the age is important there, the factor in the equation. Is there any rule of thumb that tells us, how much risk or what risks are appropriate at different stages in our financial progress?
Well, there's the old 100 rule, which says that if I subtract my age from 100, then that's how much I should have in the stock market, and the other part I should be in bonds or conservative investments.
Now, does that still hold true, or is that just kind of a general starting point for the conversation?
I think that's a general starting point. I don't really totally believe in that. I think there are some people that need to have more in the market and less in conservative investments. But we don't have to just invest in bonds and money market accounts and savings. We can invest in other things that are conservative but have proven to be a bond alternative, and those will give us a chance of making a little more money.
With those types of more conservative bond alternatives, as you put it, is there still the possibility of making some reasonable gains and progress? Because bonds aren't paying much, and they are not the golden standard of safety that they were once considered. Conservative is not safe.
Well, first of all, I never want to invest in individual bonds, because if I do, I've got to hold them to maturity to get my money. So depending upon which way interest rates go, I could end up with a 30-year bond that, unless if I want to take a loss, I got to hold it for 30 years, which the interest rate environment may be totally, a lot more. I may be able to get more interest in something else. So I want to invest in bond mutual funds if I'm in bonds at all. I think the alternatives, such as annuities, which now have been considered to be a bond alternative. I just read a paper the other day from an individual who's confirmed these annuities are like a bond alternative. And so they give us a chance to make a little bit in the market, not as much if it was invested totally in the market, but they do give me some downside protection, and they have some other things that work well too. So certainly that, along with being able to, like I said, trim my portfolio and get into sectors that are earning. There's always something. If we're in a total recession, everything's going down. This 2008, there was nowhere you could go to make money. Bonds, stocks, everything was down. but it didn't take that long to come back. So I want to make sure I'm not losing a lot, and I may end up having to go to cash, but then be ready to come back. I don't want to time the market, because if I try to time the market, I'm going to stay out of the market too long. But I want to make sure that I don't lose a lot of my principal, because I can't afford it, especially if I'm retired.
Well, and very appropriately in the context of our conversation about market risk and volatility, you brought along a list of items that make a sound approach to volatility. Don't panic, remain calm, have access to cash, just stay informed, rebalance along the way, contribute to accounts in the midst of volatility. Potentially, depending on where you are, you've got that caveat, move to more aggressive strategies or have preservation strategies already in place. Don't gamble with money you can't afford to lose. Protect your income. If you have enough, don't take unnecessary risks. Get a review. Don't time the market. Basically, all of these, John, boil down to be proactive and be prepared, not surprised. Have a plan in place, and you could probably more easily follow these steps.
Well, that's true. If we had that plan in place, we'd understand where we are and what it's going to do to my portfolio and my income if I can't make that every month. I think the key is what we talked about in the last segment, was we need to have that reserve fund. So if the market is down, I can stop taking money out of my retirement accounts, and I can use my reserve fund while the market's down, so that I don't end up with that sequence of return, Peter, that we talk about a lot. I want to make sure that if the market's down, that I'm drawing as little as I need out of my investment account, and I'm living off of my reserve funds, my pensions, and all that, so that when the market goes up, I can build my reserve fund back up. But at the same time, my portfolio, I have more money. I have more assets earning money.
And we've talked about the fact, to make the financial progress, there is a desire for growth, and therefore there is a need for growth and exposure to some measured risk and volatility to be expected. But there's also a very valid and discernible need for safety for some of our money. And the balance there is what we strike with the plan. But John, what are some of the reasons why there should be some dollars that we actually don't take risk with?
Well, as I said, that's our, the money that we need for day-to-day living expenses, our emergency fund. I would like all of my clients to have, like I said, either have a saving, I have an account with me, a brokerage account, that we've got after-tax dollars in, that, like I said, we can pull money out of that instead of taking money out of my deferred accounts, my IRA, my 401, so that those accounts will continue to grow, and I'm not pulling money totally out. I think the income plan, we don't need to be pulling any more income out than we know. The other thing is comfort. If I've got a reserve fund, and if I've got this money built up, and I don't have my debt's under control, and everything's going right for me, if the market goes down, I'm going to be at a comfort level that I'm not going to panic, Peter. And so I'm not going to sell at the wrong time or try to time the market or listen to all this advice. So we need to have safe, but safe isn't conservative, and conservative isn't necessarily safe. I mean, we talked about the fact that bonds, while they're conservative, they have been losing money now for the last 5-6 years. Mm-hmm. So you don't want to be so conservative that you lose money, because we're losing purchasing power. With inflation like it is right now, every time we're not invested in something that's bringing in an income for us, a good income, we're losing purchasing power. So, Peter, when we talk about conservative and safe, let's suppose that last year, based upon what we made in our portfolio, our portfolios here, that I had a client who had invested his dollars in the market, and we made him $125,000. Now, if we took that same dollars and invested it at the bank at 0.75%, which is what they're paying, he would have made less than $20,000 So would you rather have the 125 or the 20,000? So we can't, on a hypothetical thing, I think that really puts into perspective. We can be so conservative that we're not losing any money. Certainly banks are safe, but I've lost purchasing power on my dollars because inflation, even last year, was more than what I made in the bank.
So, John, where are the different protections out there? Where can we hedge volatility? I mean, cash, you've just talked about, may not keep up with inflation, may not earn a whole lot, may not maintain purchasing power. But I think that there is some reason, as you also talked about, that even cash can be opportunistic for that emergency account, for your day-to-day expenses, for your comfort level. But where can we actually achieve that hedging of volatility if it's something that we want to not risk but still have positioned for accessibility, for protection? What are the options that are out there for us?
Well, Peter, certainly the income protection can be handled by an annuity. I mean, there's no reason why we can't come up with an income plan that will give us a certain amount of income each year that we can have no matter what the market does, and that's going to cover us from that. Other than that, I mean, there's not a lot of choices that we can go to where we can put our money and we know it's going to be safe. But I think in a tactical approach where we manage the money based upon what the market's giving us, that we can still be conservative, but at the same time be somewhat not aggressive, but more growth oriented so that we can still make money. In our experience, and we've been doing this since 2002, managing money for people, that our experience has been that if we don't try to time the market, but we're conservative in our approach, and that we give what the market gives us, and we don't try to be over aggressive, that we can end up making money. Pretty much we can make money over time. The market goes up, the market goes down. Historically, if you widen the graph, it's a straight line up. It's just these dips and valleys. And what we have to do is figure out how we're going to handle the dips and valleys.
Us as individuals have to do so on our timeline and only take risks that we feel we can afford and that are appropriate.
Right. If I'm comfortable with the market, somebody like me, I'm going to take more risk with mine than my clients will with theirs. And I'm good with that. And I understand that. But at the same time, we have to have a income plan, a strategy in place so that we know where we are, what our risk is, and we move forward.
Well, no one wants to lose money, but we understand that volatility is part of the market experience and the investment experience. And considering protection doesn't have to mean that we necessarily give up on gains or further financial progress. You just have to be prepared with that plan in place. And that's what they do for their clients, for proactive savers and investors there at GulfCoast Financial Services, ladies and gentlemen. Pick up the phone, get that plan, or double check and review your current plan. Understand better, quantify the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, where and how you can provide leverage for your financial picture. Make the most out of and optimize Social Security and pensions and other tools that you have available to you, and find the appropriate mix of risk and safety, the dollars that are serving specific needs and purposes into the future. That's what the plan will help you do. Pick up the phone, give a call. They do offer the opportunity for a complimentary review and initial planning strategy session. 386-755-9018 is the number to reach John and the team from GulfCoast Financial Services. 386-755-9018, 386-755-9018. You can also go online, gulfcoastfinancial.net. Lots of additional tools, calculators, resources available there for you. John, any final thoughts on the risk and the volatility that we're seeing in the market right now?
Well, Peter, the thing, I was talking to a banker this morning, and I can remember when I was president of a bank that we were making home loans at 16.5% and 3 points. That was on a 3-year arm. And I remember the prime rate was over 20. And, somehow we survived. And so the main thing is you can't panic. If we look at history, Markets have cycles. We are in a cycle, and we'll get out of this cycle. The market over time goes up, but you need to know where you are in relation to your need for your assets. And then we need to take appropriate action. And my thoughts are, of course, come in and get that income plan. We'd love to work it up for you.
And they will help you with that initial review, that strategy session, the forensic financial and plan analysis there at GulfCoast Financial Services. Complimentary, no cost, no obligation for those discussions. Pick up the phone, give a call, 386-755-9018, 386-755-9018. John, we always appreciate the time, the guidance and insight that you share with us here on Financial Focus.
Thank you, Peter. It's great to be here. Have a good week.
You as well. And we will look forward to hearing from you soon, ladies and gentlemen. Give GulfCoast Financial Services a call, 386-755-9018. And we'll talk to you next time here on Financial Focus.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through GulfCoast Financial Services Inc., a registered investment advisor in Florida. GulfCoast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.